I'm Eyal Tropin from Modern Mortgage Titan, and here's what you need to know about mortgages and the real estate markets for the end of September 2022. Let's start with the great news. We just got a sneak preview of what mortgage limits are going to be for 2023. They are going up from 647,000 to 715,000 in 2023, and for King Pierce and Snohomish counties and all other high cost counties around the country, they're going up as well. For our counties here in Washington, uh, it is going up from 891,000 to $984,000 for a conventional first mortgage. Here's the even better news. We don't have to wait until January 1st, 2023. We can start originating and closing loans with these higher loan limits right now. For two, three, 4 units, the limits are going up as well. And for example, for a 4 unit, the limits are going up to 1.376 million in most counties in Washington state, 1.894 million in King, Pierce, and Snohomish County. Again, this is a first conventional conforming mortgage in our state. We can use this right now. Let's talk about a little bit about what's going on with real estate. I know that a lot of you are concerned about potential prices going down and so on. So there is some good news. There's definitely softening of the market. You're going to see a lot more houses. We talked about this in previous videos. You are going to see a lot more houses with price reductions. That does not mean that prices are significantly going down. What does that mean? Pending home sales are down 2% month over month nationwide. In the western part of the United States, it is actually up 1.4%. Overall, we're still down over 24% year over year. Home prices are down 0.3% based on Case Shiller for the month of July. We're still up 15.8% annually. FHFA, which are only looking at homes that are sold with conventional mortgages, conventional and conforming mortgages in the Pacific region, prices are down 1.6% month over month and about 10% up overall year over year. NAR, the chief economist of the National Association of Realtors, predicts that we're going to close 2022 with prices being up about 10% year over year. That is not bad. It does mean that we're going to see in some areas some price reductions. We might see in the short term, because of higher interest rates, we are going to see some home prices going down, but not enough to be worried that we're going to see reductions overall when we're looking year over year. And as I will talk about it in a second, mortgage interest rates settle down a little bit, we're going to see prices start climbing again. Home prices will start climbing again at a decelerated rate, meaning it's not going to be the high double digit appreciation that we saw for 2 years. That was not a healthy situation. We want a more normal situation. We want houses to sit on the market longer. Listen, we're still at about 50% of homes selling at or above asking price. We're still on a national average of just 16 days on the market. This is shorter than it was in 2019, which was a perfectly normal year. And house appreciation rate in 2019, about 6.5, 7%, is normal. That's what we want to see. So that is more or less where we're headed. New homes were actually up. New home sales were actually up 28% month over month between July and August. Still a little bit lower, but only 0.1% lower year over year for new homes. Let's talk a little bit back to mortgages. So, um, we see in the news that mortgage interest rates are going up because of the Fed rate hikes. We already talked about it. Has nothing to do with the Fed rate hikes. On the contrary, the inflation is what is causing the high inflation. We just saw the Fed hike the short term interest rate by 0.75% for the month of September. That was expected. And that should have brought an improvement in mortgage interest rates because, again, it shows that they're very strong about battling inflation. But that's not what happened. We saw the highest single day jump in mortgage interest rates for the 5% coupon. Actually, we had 150 basis points jump in pricing on mortgage backed securities in just one day. This is the highest hike in mortgage rates in decades. What was the reason for that? Not the fact that the Fed raised the interest rate by 0.75%, but because of the announcement that came after saying that they are not seeing the effects that they're expecting from their previous rate hikes, and they feel like inflation is still not under control, and they're going to need to do some more rate hikes later this year and possibly into next year. That gave a message to the markets that they are not confident that they're doing enough to battle inflation, and that caused this huge jump in mortgage interest rates. I actually quoted, it was a high balance loan, but I quoted 7.75% to a client last week. Well, things are not as bleak as they may sound. I told you that rates will reach 7, possibly even 8% before the end of this year, before starting to get better. We're about there. But already this week, rates are back down, and we priced again the same loan, and it was in the high sixes, low sevens, rather than 7.75 that it was just a few days ago. What happened? Help came from an unexpected source. Great Britain, the UK is also facing a lot of inflation, but they chose a different route, which seems a little weird. They started again, renewed the quantitative easing, which is the purchasing by the UK federal bank equivalent of uh, long term and some short term bonds, including mortgage backed securities. We're in a global market, so this step that they are taking has increased the demand for this type of bonds and is positively affecting mortgage backed securities in the United States. And yesterday, we saw one of the highest improvements of over 90 basis points. So just yesterday, we already took back more than 50% or almost 60% of the rate hike that happened 2 days ago. And the day before, there was another small improvement of about 30 basis points. So we're almost back to where we were 3 days ago. We're going to continue to see a lot of volatility around mortgage backed securities, and this is going to affect things long term. It probably won't be for another 6 months before we start seeing more stabilization in mortgage backed securities and start to see some improvements in mortgage interest rates. But this gives us opportunities because as home prices continue to go up, we call it marry the house, date the interest rate. People can buy a home now if they qualify, and then if mortgage rates improve, they will be able to refinance. I am sure that many people are priced out of the market, or at least priced out of the type of home they were hoping to buy. It's up to you, real estate brokers, to see if you can find still an acceptable home at a lower price point where those buyers can qualify. But if they wait, home prices are going to continue to go up, and they might still be priced out of the type of home that they want. So let's keep the grind tight, and I'll talk to you again soon with another update.